In this talk, I'm going to go over depreciation expense. So first, depreciation is calculated based on the following criteria of the asset. The type of asset it is, when the asset was placed in service, the cost basis, the business use percentage, and the depreciation rules that apply. Different methods of depreciation are used based on the different types of assets. Whether we're talking about real estate, commercial, or residential, have different rules. Personal property, such as office furniture and equipment, or listed property, which is assets used for entertainment like cell phones or computers. Note that land is never depreciable. Personal property includes a multitude of different recovery periods based on the type of assets. And a recovery period refers to the number of years the asset is depreciated. Recovery referring to being able to deduct the entire cost basis of the asset. For example, office furniture is usually under the 7-year recovery period, which means depreciation on office furniture is taken over 7 years. If an asset is used for both personal and business purposes, depreciation expense can only be taken for the business use percentage. So you must use a systematic approach to determine the total personal use and business use of the asset. And then you simply divide the business use by the total use, which equals the business use percentage. And you can times that times the asset cost basis, usually what the asset costs you. Now, simple rules apply if listed property assets are not used at least 50% or more for the business. Depreciation expense is calculated using specific guidelines for different types of assets based on different aspects of how you use the assets. Now, don't glaze over, but I want to introduce the names of a few methods of depreciation, just so you're familiar and have heard these names before. The most common depreciation guidelines that you will use are called maker's depreciation. And within maker's depreciation, there's what's called GDS and ADS rules. GDS and ADS rules have different useful life periods for different types of assets and different depreciation percentages. GDS is the most commonly used system and allows for the fastest recovering of the asset costs, which means you get to deduct more expense sooner than with the other rules. The two most common methods of depreciation are straight line depreciation and double declining balance. Now, straight line method allocates the cost basis evenly over the life of the asset, while double declining balance, as the name implies, takes a much larger percentage deduction in the first years of the asset life. Tax softwares will calculate depreciation for you, but it is good to have a general understanding of these methods. For most self-employed businesses, the accounting records are updated based on tax depreciation. If you need to use GAAP accounting, then you may need to calculate depreciation differently for your accounting records and then make adjustments for tax depreciation. But this usually only applies to bigger businesses and not contractors. Now, the date the asset was placed in service to be used for its intended use in the business is the placed in service date. Depreciation is calculated based on when the asset was placed in service and ending when the asset is either no longer used for business or is completely depreciated, which means you've deducted the full cost basis through depreciation expense over the years. Instead of beginning depreciation based on each asset's placed in service date, there are 3 conventions that determine when the asset depreciation begins in the first year, and these help simplify depreciation. The 3 conventions are half-year, mid-quarter, and mid-month convention. Most personal property assets use the half-year convention, which means they get to take a half year of depreciation in the year the asset was placed in service and a half year of depreciation the year the asset stopped being used for business. However, there is an exception if, based on the place in service date, more than 40% of all your assets you place in service during the year were done so during the last quarter, October, November, December of the calendar year. Then mid-quarter convention must be used. And mid-quarter convention means that assets are grouped together by the quarter they were placed in service, and depreciation is taken for half of that quarter during the year placed in service and half of the quarter when the asset stopped being used for business. Real property always uses straight line depreciation in the mid-month convention, which works the same way as half year and mid-quarter, but by the month. You get 1/2 a month depreciation the date you place the real property into service, and 1/2 a month in the month during the year you take it out of service. When determining which depreciation method you should use, refer to Publication 946, How to Depreciate Property, to determine which property class that applies based on the type of asset, such as real property, office furniture, equipment, etc. Property class simply determines the number of years over which the asset will be depreciated. Next, refer to Appendix A for Publication 946 and find the applicable property class, convention, maker's system, and depreciation method that apply when the asset was placed in service, and the applicable table to refer to for the depreciation percentage. So for a 7-year property, we would look to Table A1, column for the applicable year the asset was placed in service and the related percentage. Then simply times the percentage by the cost basis, and the result is the amount of the depreciation expense. That covers what depreciation is and how to calculate it. But before we finish, I will explain some additional depreciation concepts you may have heard of, called Section 179 deduction and bonus depreciation. These additional depreciation deductions allow taxpayers to write off more amounts of the asset's costs up front in the first year of purchase and use in self-employment work. Amounts of additional depreciation that are deducted are subtracted from the cost basis, and if any cost basis remains, then the remaining amount can be depreciated. Section 179 deduction has additional rules for qualifying property, but most personal property acquired by a purchase, such as office furniture and equipment, qualifies. Also, certain real property for restaurants and retail or leasehold improvements qualify as well. Section 179 allows up to $500,000 of cost basis of assets to be written off as depreciation expense in the initial year of purchase, but only $250,000 can be related to real property like buildings. However, the total $500,000 is limited if the cost of all property placed in service during the year costs more than $2 million. In that situation, the deduction is then limited dollar for dollar based on the total property amount over $2 million. For example, if total property placed in service during the year was $2,050,000, then the Section 170 max deduction is reduced by $50,000, making the limited deduction $450,000. And this limit is just because the deduction was meant to help smaller business taxpayers. The other additional depreciation, bonus depreciation, has special rules as well. But in general, it simply allows taxpayers to deduct half the cost basis, 50%, on their qualified assets purchased and placed in service during the year. You do not have to take Section 179 or bonus depreciation. So if you had a loss from your self-employment activity, you could wait to future years to depreciate the property normally. If you sell or otherwise dispose of business assets during the year, then you must complete Form 4797 and report the gain or loss on your individual tax return, just like your net income or loss from your business. In general, to calculate a gain or loss, you subtract book value from the proceeds you received. If you simply threw the asset away, then you got zero proceeds. If you sold the asset for $10,000, the proceeds are $10,000. Book value is based on the cost basis, subtract all depreciation taken to date, equals book value.